Hola, welcome to Basics Simplified. So today we're going to be looking at yet another monetary policy tool, that is Marginal Standing Facility, MSF. What is MSF? MSF is an emergency borrowing provision given to the banks by the RBI, wherein the banks can borrow up to 2% of their NTDL by dipping into the SLR based securities. I know I just said a lot of technical terms in there, but bear with me. We can cut it out into small little pieces and we can understand them. Okay, let's first start off with NTDL. What does NTDL stand for? It is net time and demand liabilities. NTDL is basically the total deposits of a bank. So when you look at it in a definition sort of way, it means that the liabilities that the banks have to pay to the customers either on a time-based manner or a demand-based manner. So what comes in a time-based manner? You have FD, RD, etc. Think of an FD and RD where the banks have to pay back the money after a set amount of years, right? What about demand-based manner? When you put in a withdrawal request for money, bank has to pay you, right? Same. So savings account, current account, demand draft, etc. So under MSF, banks can borrow up to 2% of NTDL by dipping into the SLR based securities. What do I mean by that? Let's see. When I keep saying the word borrowing, what comes to your mind first? Repo rate, right? Banks would sell their assets or pledge their assets to the RBI, borrow money and then repurchase their pledged assets. Clear? So to do that, banks need assets first. And similar to your total deposits, banks also have total assets. So let's assume a bank has, let's say, $100 million worth of assets. I'm not talking about $100 million of money. I'm saying $100 million worth of assets. Now, it doesn't mean all $100 million worth of assets can be used for borrowing. No, it is divided into two parts. The first part is your normal assets, which can be used for your normal borrowing purposes. Okay, where you pledge it, you borrow money. The second part is your SLR based government securities. What do I mean by this? We learned what SLR is already, right? So SLR is 18% of your NTDL that the banks have to maintain for both safety purposes and to control money supply, right? So when you say that SLR is 18% of NTDL, what does it basically mean? So your total deposits, that is your NTDL, it's divided, let's say it's 100%, it's divided into 18% under SLR and 82% under other. This 82% is what banks use to make money, right? They give it out as loan, they get interest, they get the loan back, the process repeats. So this 18% comes under a requirement which the banks have to maintain. They can maintain it three different ways: money, liquid gold, or government securities. By maintaining that in that way, they are ensuring that if a situation occurs where the banks lose money, they still have 18% left, right? Under MSF, a bank can borrow up to 2% of NTDL by dipping into this part, SLR based securities. Okay, so if the total assets, out of total assets of 100 million worth, let's assume 82 million is for your normal ones and 18 million is your SLR based asset worth. Okay, so under repo rate or any normal interbank borrowing, right, they can borrow using this 82 million worth of assets. What if that is all used up? Bank has borrowed from banks and from RBI and the whole $82 million worth of assets is used up. Now the banks have no assets left for borrowing because they cannot touch this. But under MSF, they are permitted to touch up to 2% of NTDL by dipping into the SLR based securities. So under MSF, they have the provision to put their hands in this part, which is normally a no-no. They are not supposed to touch, right? So now that we know this, You'll be thinking, okay, if the banks can use this to borrow, why are they not doing it the whole time? What is preventing them from doing it? That is because if, let's assume repo rate has a 4% interest rate which is fixed by the MPC. If the banks are going to borrow from MSF, they have to pay 4.25%. So what does that mean? MSF is much more costlier. That is because normally if the banks do not hit the 18% of NTDL target for SLR, they are charged a penalty. Okay, but under MSF they can like ignore the penalty because it's an emergency provision, right? So to ensure that this doesn't get misused, the MSF interest rate is always higher than repo rate. Okay, now you will be thinking, is that the only difference between repo rate? Repo rate is borrowing, MSF is emergency borrowing. Repo rate has a cheaper interest rate. Is that all? No, there are two other major differences which shows why this was pretty much very important. The first one is, under repo rate, a bank can borrow only a minimum of 5 crores. They need to borrow 5 crores and above. Even if a bank needs only 1 crore, when they come to repo rate, they can borrow only a minimum of 5 crores and above. There's no leeway in that. Okay, but under MSF, a bank can borrow from 1 crore and above up to 2% of NTDL. Clear? Okay. The second major difference is a repo rate covers all commercial banks, whereas MSF covers scheduled banks. Now you will be thinking, what's the difference? The difference is, when they say commercial banks, it covers both scheduled and non-scheduled banks. So repo rate facility is available for all the banks, whereas MSF is available for only scheduled banks, those which come under the second schedule of the RBI Act. So to summarize, under normal repo rate or interbank trading conditions, the banks would use the assets which come under the normal category. There's no word as normal category, I'm just making it simple for you. Okay, the banks would use the assets they have under this category to pledge or sell and get the money. Once this is expired, banks can, through an emergency provision of MSF, borrow money by dipping into the SLR based government securities. Can they do for all of the SLR based government securities? No, to a maximum of 2% of NTDL. Okay, so repo rate would be your normal borrowing, whereas MSF would be your emergency situation borrowing. Clear? Have a good day. Thank you.